Imagine making money from real estate without ever fixing a toilet, dealing with tenants, or managing properties. What if I told you that thousands of everyday investors are doing exactly that right now, and some are earning returns that make traditional stock market gains look like pocket change? Welcome to the world of real estate syndication, and by the end of this video you'll know exactly how to get started, even if you've never invested a single dollar in real estate before. Real estate syndication might sound like some complex Wall Street term, but it's actually beautifully simple. Think of it like this. You and a group of friends want to buy an expensive apartment building, but none of you can afford it alone. So you pool your money together, hire an expert to find and manage the property, and everyone shares in the profits. That's syndication in a nutshell. Except instead of friends, you're joining with other investors, and instead of guessing, you're following a proven system. Here's what makes this so powerful. While you're sleeping, your money is working in real estate markets across the country. Professional teams are finding undervalued properties, renovating them, increasing rents, and selling them for substantial profits. Your job? Write a check and collect returns. It's like having a real estate empire without any of the headaches. But before you get too excited, let's break down exactly how this works, because understanding the mechanics will determine your success. Every syndication has two main players. First, there's the syndicator, also called the general partner or sponsor. These are the real estate professionals who find the deals, secure financing, manage renovations, and handle all the day-to-day operations. Think of them as the quarterback of your investment team. Then there are the passive investors called limited partners. That's where you come in. You provide capital, typically starting from $25,000 to $50,000, though some deals accept less. In return, you receive ownership shares in the property and regular cash distributions, usually quarterly. Plus, when the property eventually sells, you get your share of the profits. The beauty lies in the structure. Limited partners have limited liability, meaning your maximum loss is your initial investment. You're not personally responsible for the property's debts or liabilities. Meanwhile, you benefit from professional management, economies of scale, and access to deals that individual investors typically can't touch. Now, evaluating syndication opportunities requires a systematic approach. Start by examining the sponsor's track record. How many deals have they completed? What were the actual returns versus projections? Request references from previous investors. A reputable syndicator will gladly provide this information because their reputation depends on investor satisfaction. Next, analyze the deal itself. Look at the business plan. Are they planning to renovate units, reduce expenses, or improve management? The strategy should be clear and realistic. Examine the market fundamentals. Is the area experiencing job growth, population increases, or infrastructure improvements? These factors drive rental demand and property values. Pay close attention to the financial projections. Conservative sponsors will show multiple scenarios, including what happens if things don't go perfectly. Be wary of projections promising unrealistic returns or assuming everything will go flawlessly. Real estate is cyclical, and good syndicators plan for various market conditions. Let me share a real success story. Sarah, a teacher from Ohio, started with $50,000 in her first multifamily syndication. The sponsor acquired a 200-unit apartment complex in Austin, Texas. Over 18 months, they renovated units, improved amenities, and increased occupancy from 78% to 95%. Sarah received 8% annual cash flow, and when the property sold after 3 years, her total return was 67%. Her $50,000 became $83,500, all while she continued teaching full-time. However, syndications involve significant risks that many beginners overlook. The biggest mistake is not thoroughly vetting the sponsor. Some inexperienced syndicators overpromise and underdeliver. Others lack adequate reserves for unexpected expenses. Always verify their experience with similar properties in comparable markets. Another common error is not understanding the hold period. Most syndications last 3 to 7 years. Your money isn't liquid during this time, so never invest funds you might need for emergencies. Also, returns aren't guaranteed. Market downturns, unexpected repairs, or poor management can significantly impact performance. From a legal standpoint, syndications are securities regulated by the SEC. Most are offered under Regulation D, specifically Rule 506B or 506C. This typically requires you to be an accredited investor, meaning you earn over $200,000 annually, or have a net worth exceeding $1 million. Some syndications accept sophisticated investors who meet certain knowledge criteria instead. Key documents include the private placement memorandum, which outlines all deal details and risks, the operating agreement defining everyone's rights and responsibilities, and the subscription agreement where you formally commit to invest. Read these thoroughly or have an attorney review them. Getting started requires building relationships with quality syndicators. Attend real estate investment meetups, join online communities, and consider working with established platforms that vet sponsors. Many successful investors start by investing smaller amounts with multiple sponsors to diversify and learn different approaches. Artificial intelligence is revolutionizing how investors track opportunities. Tools like real estate investment platforms now use AI to match your preferences with suitable deals, analyze market trends, and even predict property performance. Some platforms aggregate syndication opportunities from multiple sponsors, making comparison shopping much easier. Your next step is simple but crucial. Start educating yourself today. Join investor groups, attend webinars, and begin building relationships with reputable syndicators. Remember, the best deals often go to investors whose sponsors know and trust. Start small, learn continuously, and gradually increase your investments as your knowledge and confidence grow. Real estate syndication isn't just an investment strategy. It's your pathway to building generational wealth through real estate without becoming a landlord. The opportunity is real, the returns can be substantial, and the time to start is now.